Well, it looks like today's the day that the mainstream finally wakes up to the fact that the recession that I've been calling for a couple of years, that has seemed pretty obvious to me would happen, eventually, is now becoming more generally accepted. And that's because, the number one indicator of a recession for Wall Street folks tends to be the yield curve, specifically the spread between the 10-year U.S. Treasury bond and the 2-year U.S. Treasury bond. And under ordinary circumstances, the longer term, the longer the length of the term of a bond, the higher interest it should yield. And this is because generally you're giving up your money for a longer period of time, and so you're going to demand, investors are going to demand a higher rate of return over that time because their money is tied up for a longer period of time. Think about it. If you had to put your money away somewhere where you couldn't access it for 2 years, versus 10 years, you'd probably want a little higher interest rate to incentivize you to put your money away for 10 years. But right now, actually, the yield on a 2-year Treasury bond is higher than that of a 10-year Treasury bond. Now, there's kind of two reasons why that happens. I've never heard a lot of people try and explore why exactly long-term interest rates fall below short-term interest rates before a recession, but the way I see it, it can be one of two reasons. The first reason being that if there's a recession in the near term, then the risk on shorter-term bonds may be viewed as being higher relative to long-term bonds when the recession is over. Even though the U.S. government can print as much money as it wants and pay off all of its debts at any point, there is still a somewhat of a chance that if a recession comes, revenues fall, tax revenues fall for the government, and they're unable to service their debt and they have to default on some of it. And so you may see that bit of risk being showing up in the yield curve, and that being part of the reason why short-term interest rates are higher. Now, there's also the reason why the curve inverts is because investors, your bond traders expect long-term interest rates to fall. That's the other side of the equation. Either you have, rising short-term rates or falling long-term rates, and of course these are always relative terms because they may both be moving in the same direction but at different speeds. So those are the two basic reasons why I think that your yield curve inversion precedes a recession. That's not something I learned in college or anything. It's just something that it kind of makes sense to me. And now the inversion of the 10-year minus the 2-year spread there, it preceded every recession since World War II, but there have been a couple false positives. So the yield curve is inverted 9 times since World War II, I believe, and only 7 of those resulted in recessions. I think I have that statistic correct. So that means you had 2 false positives. So there were 2 cases in which this part of the curve inverted and there wasn't actually a recession. Now, I don't think this will be one of those times, though, because I've been expecting a recession for long before this indicator, was detecting that there was a recession coming. I think that there are other reasons why there is a recession. This is not the only indicator. So there are times, perhaps, where everything looks great, and then the yield curve inverts for some reason unrelated to economic prospects, and there ends up not being a recession. But in this case, I think that the ingredients for a recession have been here since the Fed started raising rates back in, late 2015, December, I think, of 2015. And if you look back to 2016, in the months after that first rate cut, it seems to me like the economy was heading into a recession at that point. Things were not looking good. The data was not showing up particularly well. Generally across the board, things seemed to be slowing down, and I thought at the time that we were moving into a recession. However, then there was the shock victory of Donald Trump, and that, I believe, the night that Trump was elected over Hillary Clinton, I believe is when this market sort of started a sugar rush of optimism, and since then, over the last 3 years, has really been driven by headlines, for better or for worse. And by this market, I don't just mean the equity markets and the bond markets. I mean the entire U.S. economy, I think, has really been propped up by a lot of optimism. There also were those tax cuts, which the promise of tax cuts after Trump got elected was an excellent source of stimulus in the short term for the economy. And then when the actual tax cuts came, that also gave a bit of a boost, and since then we've been on trade talk optimism and then Fed rate cut optimism, and there's been all this. So it's all been headline driven, I think, since the end of 2016. Had Hillary been elected, as Peter Schiff likes to say so often, there probably would have been a recession, and that's not necessarily Hillary's fault, obviously, because she will have just come into office, but the business cycle was ending in 2016. That's just the way it was, and it seems like Trump has extended it by a few years by just pumping as much happy talk and whatnot into the economy, and that all the optimism and growth that came from Trump's election really gave the Fed the cover that they needed to keep raising rates, because after the Fed got through 2016 without any sort of catastrophe after they cut rates the first time, they thought, well, I guess cutting interest rates really isn't all that bad for the economy and that it can handle it. But of course, that simply is not the case, because the entire economy was built on a cheap money bubble that was created by the Fed after the bursting of the last cheap money bubble in 2008. Our so-called prosperity since 2009 has been based entirely on cheap money and people being able to, borrow money and invest it in just about anything and start just about any kind of business as long as it makes a small profit and they're able to service their debt. People don't have to be too particular about what sort of projects they invest in and what sort of businesses they try and start, because interest rates are so low they can afford to start all these businesses that don't really make much money. And of course that has contributed in large part to the now increasingly worrisome corporate debt bubble, which is not something I'm going to get into in this video. But needless to say, such a debt bubble is unsustainable once interest rates begin to rise, because then all of those unaffordable and underperforming investments suddenly become rather unwieldy. And so now that interest rates are somewhat higher and the air is starting to come out of the bubble, the Fed and the President both are trying their darndest to pump more air back in with rate cuts and trade talk optimism and other sorts of good headlines that the markets can rally on, because the last thing, of course, that the President wants is a recession going into the 2020 election. If anything, the President would like to stave off this recession until after the election. But we've still got more than a year to go until Election Day, and it will be very difficult, I think, to hold off the forces of nature on this one. Remember that the Fed only has 200 basis points left of interest rates to cut before they get back to zero. So that means that the Fed rate cuts will not be able to soften the landing as much as they did in 2008, which means we're probably going to be going back to QE pretty quick here. I think that the Fed will be back down to 0% interest rates long before the 2020 election, probably by summer at the latest, because I just don't think that the President and the Fed have saved enough good headlines to last us another year. The market needs good headlines pretty much every day to keep it going up. So on that note, if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.